All right. Looks like we are live. 20 people watching. Excellent. Good to go. All right. Well, good morning, everybody. Sorry for the late start. I had to restart my computer twice for updates that I had received, so apologies. Welcome to week 4 of the Rational Investor School for Trader Development. This is the third part of the initial piece of the thing, which was how to build an investment plan and how capital markets work. We're specifically talking about technicals this week, which is great. You're gonna enjoy that. We will have next week. We're gonna go back to some more vegetables, and then we're full-fledged into the candy store after that. So, somebody looks like I got some good mornings. So if somebody can give me a thumbs up, just let me know you can hear me loud and clear. I think everything's fine. It looks good on my YouTube, but I want to make sure you guys can hear me. Right. All right. Topics we're gonna cover. All right. So we're gonna cover from a very high level perspective, technical analysis. We're going to talk about how it's a proxy for supply and demand, drawbacks and limitations, different types of technical analysis, how we look for confirmation from a higher time frame. We're going to talk a little bit about price analysis, defining what a trend is, which is actually very important, right? And it's something people lose sight of as they get deeper into technicals. But it is really important. You have to fundamentally understand. Okay, what do we mean by a trend? Awesome, thanks, guys. And then what do changes in those trends look like? Which is really kind of the key thing that we want to get across this week is how do you identify those changes in trend? And then we're going to talk a little bit about indicators, oscillation versus momentum, convergence and divergence. We're going to talk a little bit about intermarket analysis, and then we'll wrap up by talking about the technical analysis tool belt. So, technical analysis. We talked about fundamental analysis last week, where we looked at the valuation, the fundamental valuation of different assets. Technical analysis, on the other hand, is the study of price action, the movement of price, right? And that's where we get into charts like this. We talk a little bit about the juxtaposition there, right? The helpful illustration that Brian does in the video is when you look at a fundamentalist and a technician in the shopping mall, right? The technician is looking at price and the movement thereof. The fundamentalist is looking at traffic patterns in the mall and how busy of a day is it, what day of the week is it, that sort of thing. Okay, so ultimately, it's important to know that while price analysis, technical analysis, gives us a really good picture of the supply and demand in the market, ultimately the market is the final arbiter. The market will decide whether price is at equilibrium or not, right? Which is really what we're trying to arrive at when we look at technical charting. Is that's a visual display of supply and demand, and the market will always try to find the equilibrium in there. Okay, Brian, you want? I'm trying to summarize it a bit, but if you want to give some more detail, that would be fine. Yep. As Brian says on the the shopping mall analogy, the technician's looking at the foot traffic. And the fundamental analyst is looking at the price of the product, the cost of production, the quality of materials to determine value. Right. All right. Now, drawbacks and limitations of technical analysis. Technical analysis works best in absence of new fundamental drivers. Now, don't we don't always have a situation where we have no new fundamental drivers, and that's why we like to see at TRI an intersection of technical analysis and fundamental analysis, right? Areas where we have the new fundamental drivers and they are in alignment or correlation with the technical analysis that we're doing. Yeah, that's a good analogy, Leroy. Foot traffic equaling volume. Yep, absolutely. All right. So there are three schools of technical analysis. Right? There's price analysis, there's indicator analysis, and then there's intermarket analysis. Okay. Um, Price analysis, right? We're looking at the direct price movements. Indicator analysis, where we're looking at kind of a first level derived um, indicator, and that indicator can come from price action or volume action. Um, and we'll get into that a little later. Okay. And then intermarket analysis, where we're looking at the correlation or inverse correlation between two markets, right? When we talk about like the Dow Gold ratio, that's the correlation between the Dow Jones Industrial and the gold market. When we look at futures spread correlation, we're looking at the spot market versus the futures market on a given asset. Intramarket Andre says intramarket analysis, he doesn't get the call put. So the call put spread has to do with options, which we won't again get into in level 1 really. But calls are long positions or bullish positions on an asset. Puts are bearish positions on an asset. And so when we look at the spread between the amount of people and the volume of people that are in bullish positions versus the people that are in bearish positions, that can give us a picture of the market. And Mr. Alaska says, I don't know how we know which markets are correlated. Well, we don't necessarily just rely on ourselves for that. We look at some other studies people have done between markets, and they can determine correlation. If I can dig it up, I probably won't do the course of this video, but later on, I have a series of videos that are on YouTube that somebody did that talk about how to determine the beta of two different assets together, which is basically looking at mathematically how to derive the correlation based on historical price action. It's fairly involved, and they do it all in Excel, which is nice, so you can really see that. But I'll share that later on if you decide you want to deep dive into how to determine correlation between assets. There's a mathematical approach to that. All right. Oh, nice. So we've got a good link here to. Let me go there to the site too that you can put in ticker symbols, and it will show you correlations between those two ticker symbols. I assume you can put 2 in here. All right. So last but not least, at least on this page here, is confirmation by a higher time frame. You will hear Brian or Thomas or myself, any number of veterans on the site, we'll often use the phrase look left, right? And that's what we're talking about in a lot of respects, right? We're looking at historical information, but also if you're on a daily, right, you might see action here, and then if you drop out to a weekly, that action might look like a pullback, right? We might see this overall move. So what we often want to do is look at a higher time frame to make sure we're not moving against the tide. Max, as far as intermarket, they're not necessarily similar. You might be looking specifically for an inverse correlation, in which case the two things might be dissimilar, but um, they might inversely correlate very well. In other words, they might move against each other uh, with regularity. So if one moves up, the other moves down, right? Um, Gold and the dollar are, in a lot of respects, are dissimilar now, right? But we often look at the correlation between the gold and the dollar because they are inversely correlated, or very often are inversely correlated. All right. So, price analysis, right? So we want to get a feel for, this is very important, the current market state. Are we trending or are we in a ranging market? So, trending, where we're getting higher highs and higher lows, or lower highs and lower lows, right? Those are trends. Um, but if you, and this is kind of an important point, right? As you drill in, we will see trends. As you pull back, very often those trends on a sufficiently large time scale will be ranges, right? Um, but it's about identifying whether you're in a ranging or trending market for the particular time frame that you're trading, right? And maybe one scale of time frame up from that. So if you're trading a 30-minute chart, it's going to be important for you to know, are we in terms of like a 4-hour chart or a daily chart, are we in a bullish or bearish trend, or are we in a ranging market? So in trends, because we have higher highs and higher lows, or lower highs and lower lows, we look for a different type of setup, and we'll get into that a little later. But we want to look for pullbacks against the move, and then once those complete, then we have an opportunity to get in for the continued move. Versus in a range, where we are looking at the exhaustion of a trend, right? And the reversal of that. Now, in either case, because so say we're in a trend and we're looking for a pullback, locally, as you get closer in, drill into a shorter time frame, that creates a trend up and a trend down. Like say we're in a bearish market and we're coming down, and then we pull back up. It's a reversal in trend on a shorter time scale, and then another reversal in trend, and that continues also on the overall trend on the larger time frame. So that's an opportunity on a trending market. So let me show you on here. So, for instance, we had, where's that? Right, we had this big long trend up, right? And this is on a weekly. So if we come to a daily here, move back to the appropriate time frame. All right, we had a move up. We were in a strong trend, right? We pulled back, and then we look for a continued move up. Okay. But in the larger viewpoint, right? In the larger viewpoint, can you see how we might not have gotten into this trade? Because if we look left, if we pull out to a larger time frame, we can see we are up near the top of this move, right? We're pretty overextended. And there are some other indicators that would tell us not to get into this particular trade. But that's what we mean when we say, you don't want to swim against the tide. Whereas if we had been down here, right, and we'd seen this move up, we might have gotten in down here because we can see some other indicators down in RSI that would give us a good indication that we are not overextended, right? So that's what we mean when we're saying don't swim against the tide, right? And why it's important to understand the difference between a trend, right, or a reversal, right? Range. So when we came up here and we put this double top in, that makes this look a lot more like this is the top end of a range from here to here, right? Hopefully that makes sense. So Max says, would it be a good idea to see consolidation first, even after a trend, before deciding where the next trend would be? Absolutely, and that's where we get into these market reversal patterns. Okay, so if you notice here, triangles are all about consolidation, right? We came moving up, we start bouncing tighter and tighter. We're coiling, is what we often call that, right? And that is the consolidation that happens before we break out one way or the other, right? And the breakout is where we see the W confirmed or the M confirmed, right? Similarly with Head and Shoulders, right? We had been coming up and then we start consolidating and then we break down, or on an inverse, Head and Shoulders break up. Yeah. Yeah, correct, Varg. He says, so an upranging market kind of looks like a big collection of W's. Yeah, yeah, because we're seeing higher highs and higher lows. It will often look like a series of W's, right? Because we're making higher highs and we are making higher lows. And that's kind of what you're looking for with a W. Now, Brian also shared a couple of things here regarding intermarket relationships, right? Example of similar assets. If I can load the thing, hold on a second. Come here. Copy link. Right. So this is gold and silver here, right? And then we have examples of unrelated markets, right? So if we come over here, this is the Dow Jones Gold market, right? So these are unrelated markets, but obviously gold and silver are closely related. Either one gives us good information. We just have to kind of understand how we're going to analyze it. Rim says, to see the bigger trend we were in, do you use the weekly chart when you're trading on a daily chart? Yeah, so generally speaking, I start on a weekly chart to give me an idea of location and market state, right? On a weekly basis, I'll often look at moving averages and other indicators that you're going to learn in level 1. Moving averages, really, we don't get into that heavily until level 2, but I'll start on a weekly basis. Then I'll drill in. Now, most of my setups, the time frame I prefer to work on is a 4-hour time frame. So I'll start on a weekly, then often I'll come down to a daily to see where we're at on the day, right? And really, I'm looking at the last few days, maybe the last week, and then I get into a 4-hour, and that's where I do my setups. Now, everybody has a different time frame they prefer. I'm not necessarily advocating a 4-hour time frame. Some people prefer a very short time frame. Some people prefer an even longer time frame. I would say, though, as you become familiar with it, it is easier to operate. You have more room to breathe on a larger time scale. So I would start looking for setups in level 1 on a weekly time scale, and as you get comfortable with that, move to a daily. As you get comfortable with each time frame, you can kind of move down to the next one until you get to the point where you move down to a time frame. So for me, for instance, if I move down to a 15-minute time frame, way too short for me. I get anxious, right? And I pick up on that. So if I drop down to a 15-minute time frame, I'm like, I start getting really anxious, and that's where I know, okay, that's too low. I'm going to move back up. So the shortest time frame I'll typically trade is a 30-minute, but everybody will find their own kind of equilibrium, right? I know people that are perfectly happy trading on a 5-minute time frame. That's not me, but some people are. So hopefully that answers you. Typically, the scales I work with are weekly, then daily, then 4 hour, then 1 hour, then 30 minute. Okay, that's kind of how I consider each level up, right? So if I'm on a 30 minute, the next one up is really a 1 hour. If I'm on a 1 hour, the next one up is a 4 hour. If I'm on a 4 hour, the next one up is a daily. If I'm on a daily, the next one up is a weekly. Mr. Alaska, BCS's Broiler Chicken Show, the Sunday offering. All right. Where were we? All right. So these patterns, these reversal patterns, are very, very important for you to learn. You're going to be using these in price action. You're going to be using these in indicators. Okay. So you use this all the time. It's really important that you practice with these reversal patterns. Okay. Identifying triangles, and it's all about the movement of the highs and the lows. So like a triangle, right, is a regular symmetrical triangle is lower highs and higher lows until it breaks out. Okay. Whereas an ascending triangle is relatively level highs but higher lows. A descending triangle is relatively level lows and lower highs. Okay. So it's all about that, and it's best if you kind of think about it in terms of that, right? So these patterns, hugely important, very powerful. Now, it's important to note, and I don't want to go down this rabbit hole too far, but it's important to note, if you Google around on specifically harmonics, you're going to find areas where people talk about a W where it goes bearish or an M where it goes bullish. Those are very, very specific exceptions to the rule that we get into in level 2. Okay, that's where we get into advanced harmonics. I think it's level 2, it might be level 3, but very advanced harmonics. Don't worry about that. Right now, what we're looking at is simple harmonics. So we're looking at W's being a breakout into a bullish trend, M's being a breakout into a bearish trend. Does a symmetrical triangle always break up? No, not always. Not always. It can break down or up. Can you see how if we had come up here, let's see if I can find one. All right, so we have a triangle here. Okay. Come here. A little bit sloppy, but okay. So we had a triangle here, and I see it's a little sloppy. When we do dip down a little bit here, I could go off of this level. It doesn't really matter. In fact, let me do that just to keep it clean. Okay. And we broke down here. A triangle, if we break up, it will confirm a W. If we break down, it will confirm an M. So it can break either way. Yeah. Brian stresses here, don't be concerned with lower time frame setups, please. And yeah, as I said, you want to start with a higher time frame, and as you get really comfortable with it, move to a lower time frame. If you feel anxiety building, move back up to the previous higher time frame, okay? And start with a weekly and then work your way down. How many points of contact are necessary for a triangle? Well, it's less about the number of points of contact, though there is a kind of 1, 2, 3 thing we look for with triangular breakouts, but it's more about we're going to move about 3/4 of the way through a triangle, right? We typically break out kind of in the nose here, about in the last about quarter of that triangle. So if you look at the starting here, right, coming down to here, you can see how it's getting progressively tighter. Typically, we will see a break somewhere in here. Now, as it happens, think about M's and W's, right? We had 1, 2 tests, and then a third test. If we break up, we'll make that W. But it doesn't always happen on 3, right? So I'd be less concerned about we have to have a break here. I would say you have to have at least 3. because you need a W, right? But it could be 5, 7, 6. Um, Brian's about to give us an example of a good high time frame W. I'll share that once we get it up. Straight Doge asks, is the lowest time frame we should be working on a 4-hour? Doge, I would recommend right now work on a weekly. Okay, we're gonna be learning a lot of new material until we have gotten to the end of level 1. I would stick with weeklies. If you really got to go lower, maybe dailies, but I wouldn't go lower than that yet. Okay. All right, let me get this sample that Brian brought up. There we go. So there's an example of a good high time frame weekly W, right? And you see how we came down, came up, came down, and came up, and really I would say the down was more like from this level, right? Down, up, down, break up. Okay. Colleen, I'm not sure what you're saying there. In the case of BTC, tinier and tinier right to the very tip. I think you're making a joke, but I'm dense. I'm sorry. I don't get it. Yeah, so let's stay on weekly time frames, okay? Especially as we're learning all this new material and getting comfortable with it. You might try dailies just so you get the habit of looking at a higher time frame for confirmation of a lower time frame, but I really wouldn't go lower than a daily time frame. At least not yet. All right. All right. So these reversal patterns, very, very important to learn. And then we talk about how often the confirmation of a breakout, right, or a breakdown, is reflected in volume, right? You can see how here. Let me just so you guys know, if you're looking at volume, something you can do if you just want to see bearish volume or just want to see bullish volume, you can take this and make that so that it's transparent. And then you can really get a good view of bearish volume. So can you see how we were coming up here? We were forming this triangle, and before we got into this, what did we see? We saw a big spike in down volume, right? And when we finally broke down and confirmed this M, right, we got another big spike in bearish volume. I might have said bullish there. I meant bearish. Okay. Those volume spikes are really important for confirming these moves. All right. You guys are goofballs. All right. So then we get into indicator analysis. Now, right now, we're just going to look at RSI. It's relatively simple. When we get in later, we're going to look at another momentum indicator called MACD in a few weeks. We're going to look at a few different oscillators as well. And yeah. An indicator is any class of metrics whose value is derived from generic price activity in a stock or asset. Technical indicators look to predict future price levels or simply the general price direction of a security by looking at past patterns. Examples of common indicators include relative strike index, Monday index. Now, I only have one problem with this definition, and that is it is saying that an indicator has value derived from price activity. We do have indicators that instead of from price activity derive them from volume activity, and we'll get into that in this course. But generally, this is a good definition. So oscillation, right, Oscillation is what we look to show us overbought and oversold. So in the case of RSI, we have these bands, right? When we move above this band, it is considered overbought. When we move below this band, we have a little tip there. Let me go back. See, there we go. We have oversold, right? Hang on, there's questions. Do you have a rule of thumb on where to put a target from an M or a W? Varg, we'll get into targeting when we do location, which is in 3 weeks, I believe. Let me look here. Week 6. So in 2 weeks, we're going to get into location. When we talk about location, that's when we're going to look at where to put the target from MRW. As Brian says, 50% rule should be your default target. What we mean there is 50% of the move of the previous move. So, well, that's not price, but in this move up, right? M breakout, a target should be 50% of this move up. And I'll show you in a couple weeks how we draw that, right? All right, so oscillation tells us overbought and oversold, right? Momentum is where we are looking for those reversal patterns in the indicator itself. So that's where we're looking in RSI for M's and W's, right? Higher highs and higher lows to tell us a trend in momentum. And the idea of divergence is when we have a trend in momentum that is at odds with the trend in price, okay? So can you see how during this period here, turn off the extensions, there we go, we had to move down here, and at the same time, we were making higher lows here, higher highs. So we had a trend here, right? And lower highs and lower lows here, right? Can you see how that, what we mean by divergence? Price is going up, momentum is going down. We look for that all the time, right? You'll hear us talk about momentum divergence. Now, the difference between an unconfirmed and a confirmed divergence has to do with M's and W's, okay? So, and we're for a momentum that's moving us down in the indicator like we have here, okay? What we're looking for is an M, right? Come up to here, down to here, up to here, down to here, right? At this point, where we've crossed this, we have confirmed an M here. And what we need to know up here is price is moving up and we have a confirmed M. That's our confirmed divergence at this point, okay? That's what we mean by confirmed. All right, so Brian's giving you some advanced information from a couple weeks from now, so watch the chat here. We asked about targeting. Here's what we mean, okay? So we had the move down here in Pixis. Got a W. Our normal target is a 50% of that move. And we want to see where the risk reward, and I'll show you how to use this tool in just a second, is at least 2 to 1, right? We have to risk to a break of the lows from this, but we are looking to take profit up here. So let me show you that really quick. So let's look here. So in this move up, bullish move, okay, we had this W come in. It confirmed here. And see this tool over here, it by default is giving you a long position. This is a short position we're looking at here. And we can just select that and then come to this point, right? Move this down to 50%. And the top part of it, we have to move this to line up with a break of new highs, right? So we look at that and say, at this point, is this at least twice as far as the move back up to come back to the trend? In this case, it would be 2.18 to 1, so that would be sufficient. We don't ever want to get in on a trade that's less than 2 to 1 risk to reward. As we get into setups, you're going to find some setups that will, particularly when you get to like level 2 and level 3, you'll see a lot of setups that are like 3 to 1 and 5 to 1 risk to reward. Or sorry, reward to risk, right? So that tool is very, very handy in TradingView to give us an idea of where to take profits. Okay, and we'll go through in a couple weeks and we'll show you how to set up your Fibonacci retracements. Yeah, so confirmation, very, very important. And Colleen, you talk about volume confirmation. Yeah, there is volume confirmation too. We will get into our volume study in 4 weeks. So let's reel it back in. Yeah, Andre, sorry, I'm trying to keep us on task here. Okay. So oscillation gives us an idea of overbought and oversold. Momentum, where we are seeing the trend in volume, or sorry, the trend in the indicator and the trend in price. That trend in the indicator gives us an idea of momentum. Okay, so we have oscillation, we have momentum. Now, not all indicators, if you look at a MACD, for instance, MACD is not an oscillator. There's no overbought or oversold section. It is purely a momentum indicator. If you look at Willie, which we use, and we'll teach you how to make Willie, which is a Williams percentage R, that is another oscillator, but it is pretty purely an oscillator. Okay. So, for right now, for this point in the class, go ahead and throw RSI on your studies, right? And what I want you to do is look for these reversal patterns, these triangle breakouts, M's, W's, heads and shoulders, right? On a weekly scale, I want you to look for these in price and look for them in RSI. Okay, and if you can find an M in price while you have a W in RSI, highlight that for me. Okay, put that up on the group tutorial or the group log. So to remind you guys where that is, we haven't really been using that really heavily yet because we're just now getting to where we can do some technical charting, right? Where are you at? So if we come in here, go end, scroll your way down, we have the group trading plan here. Okay. Go ahead and throw them in here. We've got some stuff in here already, which is great. I will be reviewing this, I promise. You can grab a screenshot from your setups. Feel free to draw on it however you like, right? You can put text on here as well, right? Explaining what you're seeing, and then use this button here on the upper right to take a snapshot of it, and that'll give you a link that you can then put into the spreadsheet here. So we're looking for, sorry, Andre, or Mr. Alaska, let me clarify. So what I want you to do is on different assets, right? Be looking for these patterns here in price, but also be looking for those patterns in the RSI. You can just put RSI with the default settings on your chart, right? And to walk people through how to go about that, let me get rid of it here. Okay, you're going to go up to indicators. In here, type RSI. Click on that, and that will add it to your chart. Now, it's kind of hard to see in its default setting, but if you go to the little gear icon here, you can change this color. I like red. I find it's easy to see, and you can change how bold it is with this here. And then you can really see it well. Okay, so look for that. All right. If you want to get wild with it, you can on your chart put your profit ratio. Okay. Well, that's still on a downside. Let me put it along. So if we were coming back here and we saw this W here breakout, feel free to do it here. And if you don't worry about harmonics right now. Don't worry about like Fibonacci retracements. But just bring it up until this is at least 2 to 1 to give you an idea of targeting. Okay. Hold on just a second. All right. All right. Indicator analysis. Talked about that. Intermarket analysis. We talked a little bit about here, but let's dive into this a bit. Hold on a second. So here, before we get into that, let me talk a little bit more about divergence here. Let me give you an example. So the first thing you want to look at when you're looking for a divergence, okay? Again, we need to confirm it, so we're going to need to see the other end of this as well. But what we're looking for initially in a divergence is the higher high. So if we're looking for bearish, we're looking for higher highs and lower highs on the indicator. So higher highs on the price, lower highs on the indicator. It gets confirmed when we also have lower lows on the indicator. Okay, because that's when we get the M in place. But when you begin looking for it, you're going to start by looking for higher highs on price, lower highs on the indicator. Conversely, if you're looking for a bullish divergence, you're going to look for lower lows on the price, like you see here, but higher lows on the indicator. Okay, so for bearish, the first sign is going to be off the highs, and you want to look for the same on both the price and the indicator. So you don't, for example, you do not want to look at higher highs on price and lower lows first. The first thing you need to look at is higher highs and lower highs on the indicator, right? And the reason for that is if you have higher highs here and you have lower lows here, but you have higher highs, what you have here is something we call a megaphone, where we have an expanding wedge, right? That doesn't get us that. That doesn't get us the divergence. What we really want is to see we want to see trend that is in opposition to each other, right? So higher highs on the price, lower highs on the indicator for a bearish, for a down move, right? Lower lows on price, but higher lows on the indicator for a bullish divergence. All right. All right, so a bunch of questions. Hold on, let me scroll back in chat here. Isn't there different types of RSI? There are. There's like stochastic RSI, that kind of thing. For right now, just pull up the straight relative strength index, the straight RSI. Let's not get into the other types of RSI and that kind of thing. Okay. And Mr. Alaska, I'm not sure what you mean by profit patterns. Okay. What we're learning right now is just reversal pattern indicators. Okay. We're looking for these reversal patterns. That's going to tell us that the trend that has been moving is ready to reverse. That's what we're looking for. And when we can see in the indicator, we can see that reversal happen prior to the price, which happens fairly often, that's where we see a divergence. Okay. All right. I know we're not. Doge says, I know we're not there yet, but the Fibonacci retracement, do we draw from top down? We will get into Fibonacci retracements in a couple weeks. I don't want to dive into it right now. Show the confirmation then. Okay, well, what's... Hang on. Let me look here. Link. Let's see what Brian's got for me here. All right. So, and let me share this with you guys too. All right. So we have a bearish divergence here. Okay. This is coming down. We have a bullish divergence here. We saw this breakout happening. Okay. Now, you asked about seeing the confirmation. The confirmation, I can't really draw on this chart. This is the SMH. Let me pull it up. Oh, that's what I got. Okay. So, scale daily. Bear with me here a second, guys. Okay. So like down here, right? You see how we had lower lows on price. Okay, go down here. Come here. All right. But at the same time, we had higher lows on the indicator. All right. Now, what we're looking for ultimately are M's and W's to confirm this, right? For what we call double bottoms and double tops, the same thing. Okay. So we had this, came down here, came up to here. Oh, really? Do that again. I'm going to do this a little broader. Okay, so it came from here. And where's your low? There. Up to here. Down to here. Up to here. Okay. Can you see the W there? And that W gets confirmed. Oh, hang on. Not being crazy. There we go. That W gets confirmed when we break above this middle here. Okay. That was confirmed there. Now, by the time that occurred, we're already seeing this breakout here, but we also have some other W's that happened during this, right? for instance, we had a W, get rid of this, we had a W here, as well. Sorry, I drew an extra little leg here, but we had a W here, right? We had higher lows, lower lows. We had the W breakout here. So that confirmed. Now you can see we continue to move down a bit. Now this is where we get into the idea that you want multiple indicators. This is one indicator. This is just divergence. Then we came down, we made another W here, right? Confirmed about there. So we got multiple W's happening in the indicator. And we had IMS happening in price here, right? And now price is starting to break out, and it put a W in here. Came down, put another W in here. All right. Does that make sense as far as where we confirm that at? Mr. Lester, we're looking at both. We want to see where RSI, or MACD, is in divergence from price. So we need to listen to both price and MACD, or RSI in this case. We want to listen to both price and RSI, and we want to see when they're telling different stories. And yeah, you can use the default RSI of 14 for this. That's fine. Right, right, Mr. Lasky. I'm looking at trend is going to reverse when we see divergence. Yeah, so that is one indication of reversal, right? Now, what we're going to teach you ultimately is we're going to teach you to look at location, which has to do with fibs and where we're at there, a trend versus range, right? And then we're going to look for divergence, right, with our momentum indicator, and we're going to look for price structure, which is like the W breakout in the price itself. But we'll get to that point, okay? We want these all to work together, but for right now, what we need you to see is divergence. Brian highlighted it as well. Yeah. So RSI 14 is 14 periods, whatever period you're in. If you're looking at a weekly and you have a 14 RSI on it, it's looking at 14 weeks back in time. If you're looking at a daily, it's looking at 14 days back in time. So that's, you'll hear us often say it's this period. That's because we're going to use the same process regardless of time frame, but the indicators, when they say like 14 or 21 or whatever they're talking about the number of periods based on the current chart back that it's going. All right. So Alicia asks, what does divergence tell us? What do we understand from seeing it? So what divergence tells us is that we have momentum building in a direction different than the way that price is currently moving, right? As Brian says, it's telling us that price is stronger than what price is telling us. Price is telling us it's weaker here, but the divergence is telling us that it is stronger here. Okay. I got an example here. Justin says, did I draw this right? Let's take a look, Justin. So you're just drawing a triangle breakout. Yeah, yeah, that triangle is drawn correctly. And Max says, I just want to see where in particular a good time to take positions after these confirmations. We'll get there. It's all about having this process, right? Max, what we want you to do is in a couple weeks here, we're going to teach you about location. So then it's going to be about identifying proper location to take a trade. Then the second thing we look at is going to be momentum. That's where we're going to look at, do we have signals that indicate reversal, right? So we're in a good location for a reversal. Then we're going to look at, does momentum tell us that reversal is about to happen? And then we look for a breakout. We look for the actual price structure that says, okay, that reversal is happening. And that's when we're going to get into our trades. Now, that doesn't guarantee that that's going to work. Like we said at the very beginning, what we're looking for is a win rate of at least 66%, right? Which means a third of the time this is not going to work, but 2/3 of the time it should work, right? And you're going to test this before you put real money into it. You want to make sure that your system is working. All right. If you draw your lines at different points in the chart, it seems it would not be divergent. This is a bit confusing. Well, you do want to start them at the same time, right? So, for instance, when I look at this semiconductor ETF, right? Can you see how I started here? It's a little hard to get it lined up because it's lining up based on the candles, which I'm not showing. And I started at the same spot here. So over the same period of time, we show higher lows here, but lower lows on price. Rumco says, the way you just showed drawing the broader W and RSI and the smaller W in it, it looks a bit arbitrary to me. Are there any rules to drawing M's and W's? There are absolutely rules to drawing M's and W's. I shared them earlier, but let's talk a little bit about it, okay? So a W is a move down, so followed by a move up that is less than the height of the original starting point, okay? A move down, we want this move down to finish at the same level or preferably a little bit higher than the previous one. And then finally another move up. What makes that W confirmed is when we have closed above this level. Okay? What we're trying to see here is a trend. We're trying to see higher lows and higher highs. Okay? That's what the W is showing us. Alex J says, using that same example, if you went to the next high, it seems it wouldn't be divergent. So if I went to here and I measured from here to here and from here to here, yeah, that's correct. But what we're looking for, I mean, if you go up to here, that's a higher. All right, so let me explain. So from here to here, we're talking about a higher low, right? So that doesn't fit with our trend. If we took price back to here, this hasn't broken down yet, right? So if we come back to here, and that's all we see, what we're seeing is not a confirmed trend from this point, right? It is not until we've made new lower lows in price that we have this trend in place. So at that point, that's showing us this trend is in place. And then we want to see what is the trend in the momentum indicator. Does that make sense? The confusion to me comes from your time period. Within your W, there are multiple W's and M's. That's true. But that's always going to be the case. Price doesn't move in straight lines. Price moves all over. I'm not sure what your question is. So for right now, and feel free to clarify for me, Jack, and I'll be happy to answer it. I'm not trying to be flippant. I don't really understand that. But what you're asking there. So what we're looking for here, and here's what I want you to do. Okay, on a weekly scale. Let me get rid of my drawings here. On a weekly scale, I want you to identify M's and W's. Okay. I want you to identify M's and W's, and then I want you to see if you can identify a divergence. So when you see an M and W on the chart, which is important for you to find, okay, if we see an M, like we have here, that's going to give us an M here, right? Lower highs. Sorry, I'm doing that backwards. I apologize. That's going to be confusing. Want to see higher highs here, okay, and lower highs over here in the price momentum indicator, okay. That is what gave us the signal for this pending move down. This told us price is not as strong as it looks like, and then we eventually broke down on price and moved down. Okay. Comes to the question of arbitrary selects. Well, all right, so this is not pure math. And this is an important thing to get about trading and about technical charting, okay? We follow specific rules in our charting, but one of the reasons it becomes difficult to create just a program that will look this all up is that there is a human quality of selection, okay? So we try to reduce our emotional reaction as much as possible, but this is still this is hard to define mathematically. That's not impossible, but it's hard to define mathematically when we see a divergence. Now, I know for sure that it's not impossible because we have several people that have defined indicators that show divergence. But yeah, it's a good way to double check our M's and W's. Divergence is one of the things we look for. Again, coming back to the thing that we talked about earlier, we look for very specific things in a setup. We look for location, then we look for, and this is all technical, right? This is from a technical setup. We look for location, then we look for divergence, then we look for price structures. That's our M's and W's, okay? To confirm everything together. They all need to be in place for the setup to be true. But for right now, I want you guys to be able to identify these divergences. I want you to be able to identify these reversal patterns on your chart and in the indicators. Okay? I need you to get comfortable with these. We're going to use these reversal patterns a lot. So I need you to practice with them. Chuck, what I would recommend is start doing up charts. It might become clearer if you're doing them up and you share it out, and we can say, okay, so here's why that's correct, or here's why I would do that differently. Here's why that's wrong. Okay, and that might give you a better clarity into what you're looking for here. Journey says, clarifying question, is RSI both an oscillator and momentum indicator? Yes. It is both an oscillator, meaning that it has an upper boundary and a lower boundary, and you can be overbought and oversold on it. And it is a momentum indicator, meaning we can get an idea of price action momentum from it. Off topic, how do you find momentum in BTC versus OTC purchases? So I assume what you mean by that is OTC Bitcoin purchases. which means off the books OTC purchases, things that we don't have any charting data for. There's no way to find momentum in those. If you hear about those OTC events, we have to treat them as kind of fundamental events. According to the chart, the divergence of the W in price is actually bearish. Correct. So, well, all right. So there's a couple things to note here. First of all, this is making lower lows. This isn't actually a W. But second thing to note is, even if it were a W, the divergence would indicate that we are looking to reverse. Okay. Keep in mind, we will see W's that do not result in a move higher. We still will see M's that do not result in a move lower. This is why we want to use multiple indicators to give us a setup. Right? We want as many of the pieces indicating movement in the direction we want as possible. We get a larger PowerPoint of the indicators. Yeah, and I think Brian shared in the main chat some larger pictures of each of those reversal patterns. It was a while ago. It's a few days ago. Let me see if I can find it. I don't know that it got bookmarked or pinned. Unfortunately, I still can't pin things. But yeah, so it is. So here, let me show you. So in the chat, or group, if we go to pinned messages, in here, you will see we have larger versions of each of these. And I'm with you on the being blind part. I'm a little bit blind myself. If you look in here, they're all pinned. Okay. All right. Max, confusion cleared. All right, awesome. Okay, so are we relatively clear on how to identify divergences? All right, bearish divergence. Let me share this with the thing here. Okay. Bearish divergence, we are looking for higher highs in price, but lower highs on RSI. For a bullish divergence, we are looking for lower lows in price, but higher lows in the RSI. Okay, that's what we want to be looking for. All right. In addition to that, the other thing I want you guys to be hunting are these reversal patterns. Okay. Triangle breakouts, heads and shoulders, M's and W's. It's really important that you learn what these look like. And check, I don't want you to feel blown off at all. I'm not sure how to explain that to you. So let me give it a little thought. But what we're looking for is trends in price and counter trends in RSI. And Varg says, yes, I just wonder why, if it's so we are not, wonder if it's so that we are not concerned about the lows in price when it comes to divergence. It's not that we're not concerned about it, but we want you to be able to identify potential divergence right off the bat first. Okay? So this is a potential divergence, right? right up until we have an M here. Then it becomes a confirmed divergence. But for right now, we want you to be able to do step 1, which is identify the potential divergence. Bearish, we look at tops, right? Bullish, we look at bottoms. And remember, from the very beginning of the module, the definition of a trend: a bullish trend is higher highs and higher lows. A bearish trend is lower highs and lower lows. And we will go into a lot more detail on this, as Brian says. Okay? The main things we want you to do is identify the first part of the divergence here, and we want you to be able to identify these reversal patterns, okay? Look for M's and W's. Okay? All right. All right. Intermarket analysis. We talked a bit about that. The relationship between various assets can tell us a lot about the internal health of the market broadly. All right. The ultimate fear proxy is the dollar, right? The US dollar index gives us a really good idea of the fear level in the market itself. When people are afraid, they move into the dollar. And that's international, that's anywhere, right? Keep in mind the US dollar is the reserve currency for the world, right? So when people are unsure, they move into the dollar. Cash is king. Yep, we're moving on to intermarket. And then some markets are highly correlated, some are highly inversely correlated, which means they move opposite each other, and some aren't really correlated at all, right? We have some historical relationships, right? Stocks and bonds are considered to typically operate in inverse correlation to each other. The yield curve refers to the difference between shorter term bond rates and longer term bond rates. Rusky says, until it's not. Well, so that must be in reference to the only intramarket relationship in crypto is BTC. I don't know about that. I mean, I think crypto largely hasn't been around long enough to establish enough data confirming intermarket correlations. Some people have looked at correlating crypto broadly, so like a crypto index, with the emerging markets index, but I don't know that we have enough data to establish intermarket relationships between crypto and other assets. BTC spreads, Brian talks about, is an idea of intermarket analysis, since that's where we're looking at things that have forwards contracts, right? And this is a pretty advanced concept, right? But I can show you an example of this, right? So this is the spread. Weekly. This is the spread between the 3-month forward contract on OKCoin and the spot price on OKCoin. Okay. So that's an example of an intermarket relationship in Bitcoin. Oh, that was about the. Rusty says that was about the U.S. dollar being the world reserve. It's true. It's true. I mean, the fact that it's a reserve currency now doesn't mean it always will be. However, with that said, there are a huge amount of companies and governments that are dependent on that relationship. So that's not going to move easily. So we'll see. I know that there are countries talking about taking that, removing the U.S. dollar as the reserve currency. If that happened, that would be a huge fundamental event for the market broadly. But I don't necessarily see that happening in the near future. All right. Then we have things like Dow theory, which is what we have talked about before, the Dow Gold relationship, and derivatives data. That's where we're talking about the call and put spread that we discussed earlier. All right. So intermarket analysis from a planning perspective and how to implement this into your trading plan. Okay. I use intermarket analysis to drive my very long-term view. So I'm talking the next year or two up to 5 years out is when I'm looking at intermarket analysis for driving a lot of that. Okay. In the case of the Dow theory, I'm looking at 17 and 35 years out. Okay. So that drives that. And I start from a top-down perspective on my planning. So I start with that intermarket analysis to give me that broad picture. Then I drive into shorter term cycles, all the way down to where I get into like where we at in the year and what assets are in selling position versus buying position. All right. And then last but not least, building your TA tool belt. So ultimately, the tools that you use in your technical analysis are a matter of personal fit. I know that came up in the quiz. Some people didn't catch this part, so it's important that you get this. It's got to feel right. You've got to have a confidence in the tools that you're using. So, bottom and top fishing versus momentum, they're both right? It's about what are you more comfortable with and what are you more confident in. At the end of the day, we're going to test this, right? At the end of the day, you're going to come up with the setups that you want to use. It might be setups we've already defined. You might define your own setups. Then you're going to test that by doing paper trades with it for at least 20 trades. And really, I recommend 100 trades so you have a good sample set. And yes, that can take a while. It usually takes me 3 to 4 months to vet a setup, to do enough trades in paper that I feel comfortable with that setup. And then if that setup is succeeding 66% of the time over the course of 100 trades, or I guess at a minimum 20 trades, right? Then you're okay to start using that for trading money, right? So that's where you determine what fits you, right? Is this setup working? Am I executing it correctly? If I'm executing it correctly and it's still not getting 66% winning 66% of the time, then I've got to modify that setup, right? Or throw it out and start with a new setup. If the setup is not working 66% of the time, but I'm not executing it correctly, then I need to refine how I execute it. I need to make sure that I'm executing it correctly. Okay. Then the other really important part, and this is huge, I mean, we can't stress this enough. We're going to say this probably every week until the end of class. We want 3 non-related studies. We want to layer our analysis. We want to have multiple indicators that tell us that this is a good time and place for the trade, right? That's how we put ourselves in the best possible position. It's not just about having the M&W. It's about having the M&W and good location and divergence and good fundamentals, right? If you've got all these things in place, it is much more likely that that trade's going to succeed. And in fact, for me, and I'll get into this later on down the road, I've got a method where I add risk based on each of those factors being true, right? So my highest risk trades are also the ones that I have the highest confidence in. Andre asks, can you only have one trade setup or can you have multiple? Multiples, absolutely. So I've got a handful. I mean, bearing in mind that I've been trading using TRI's method for about 4 years now, right? I've got about a half dozen setups that I use for trending markets. I've got about a half dozen setups that I use for ranging markets. That's usually how I kind of divide those up. I look at the market state and then I go, okay, we're in a trending market state. Do I have any of these setups in place, right? For right now, when you leave this course, what I'd like you to do is I'd like you to have 3 setups in your plan, right? And I'd like those setups to cover both ranging and trending markets, so you have something for both of those. That's what I want you to wrap up with. At the end of this course, I'd like you to have in your trading plan at least 3 setups that you are vetting or have vetted. Yes, we will. So this whole course is about understanding all the pieces so that we can then use those in setups. And as we get through this, starting in a couple weeks, we're going to start building a setup. It's a setup that already exists, but we're going to start building a setup that we call the 3-step setup. And that's going to help you understand how these other setups work. Okay. Highest risk is the biggest percentage money. Yeah, that's correct. That's correct. So I've got a methodology like we talked about earlier, where we go through location, momentum, and then market structure, right, or price structure. Each of those factors can either just be sufficient for you to move on, or it can add a percentage to my risk. And then I have other factors like fundamentals can add a percentage to my risk. And then other correlation can add another percent. So the most I ever do is 5%. But usually my trades are like 2 or 3%, and they're driven by how many factors are true in my trading setup. I just needed some structure around it. Mostly because I'm kind of OCD, but. All right. It's important that your 3 reasons be unrelated. Now, on a certain level, people that are very, like me, are going to say, well, they're all kind of related. They're related to the asset. Yes and no, right? There are some things, right? So if you're looking at a momentum study, if you're looking at MACD, that can be a reason. But if you have that as a reason, using RSI as a reason for momentum, those are both momentum, right? We don't want those to be we don't want those to count as 2 separate things. But if you have momentum and you've got location, right, and you've got a fundamental valuation, those are 3 unrelated reasons. If you've got location, momentum, price structure, those can be 3 different reasons, right? Did I understand correctly that, for instance, Fibonacci can be part of a setup? And Owen says, yes, location. That is correct. Location. When we talk about location, we're largely talking about Fibonacci retracements. Not exclusively Fibonacci's, as we'll get into when we get into it. There are some setups, particularly for trending setups, that use non-Fibonacci retracements, but still using the same tool, just configured a little differently. Colleen, you say at the end of level 1? I'm not sure what you're asking there. And so yeah, like we say in here, try to find one location reason, moving average, fib level, volume profile level, one momentum reason, one price reason. Now, we're not telling you to do this yet because we haven't talked about, we're not going to do moving averages in level 1. That's really a level 2 concept. We will talk about fibs, volume profiles, and other level 2 things. So for you guys, the only location tool we're really going to teach you is retracements or fib levels. We are going to talk about a couple momentum pieces, right? OBV, which is a volume momentum tool, MACD, which is a price momentum tool, and one price reason. That's where we're talking about market structure. That's what you're learning this week. And later on, we're going to learn about candle patterns as well. At the level 1, but we also want at least one FA reason to be rational investors. At least 3 steps. Correct. So you can trade purely on technicals, but I think you have the best bang for your buck when FA is one of your reasons. Now, for me, I have my 3 technical reasons, and then I only operate within my FA screeners, right? So I trade things that already match the FA. So technically, I always have 4 reasons, but my FA screener is set up in such a way that if there is a sufficient level of things that where I can trade, and then there's a thing where I can add risk for it too, right? And like I said, I'll teach you guys about that before we get through level 1. Um, so yeah, I definitely recommend. You also have FA as that. There are some setups that I have, like my planting flowers setup, where FA is one of my primary 3 reasons. Okay, um, but yeah, at the very least, and keep in mind this is the technical. We're talking about technicals this week. We do want to have at least 3 unrelated studies from a technical perspective, as well. So, how to use this information? In other words, stuff that we'd like you to do, right? We want you to find these market transition price patterns, triangles, head and shoulders, M's and W's, okay? We want you to find examples of convergence and divergence on RSI. Yeah, Doge, that's correct. I don't even give a trade a chance unless it meets my FA criteria. It's got, at the very minimum, for instance, if I'm trading an altcoin, at the very minimum, it's got to score at least a 4 on my FA screener, or I don't trade it. Yep. And then, can you think of any intermarket relationships that might help you analyze your particular asset? So, as you're looking through these assets, I want you to look for market transition patterns. I want you to look for divergence and convergence, and don't worry about confirming those. Just look for, if you're looking for a bearish divergence, look for higher highs and lower highs. If you're looking for a bullish divergence, look for lower lows in price and higher lows in the indicator. Okay. Yeah. So that's good. Uh, Naja or Naja, I don't know how to pronounce your name, but yeah, that looks good. That's higher highs in price and lower highs on the indicator. Absolutely. That's exactly what you're looking for. Mr. Alaska, how do we come up with a score? So, for me, for my crypto, so I have different screeners for different asset classes, right? My crypto screener that I use is the one that Dav came up with. It's that altcoin scoring index. Um, that I think we have it linked. I know it is on the site. So I use, go to the library, fundamental screeners, crypto altcoin scoring model. Okay, so I use this. Each one of these factors can add a +1 or a -1, right? I need a score of at least 4 for me to trade it. His says 3, but for me, I need at least a score of 4 to trade it. If I have a score higher than 4, then I will add a percentage of risk to my trade. Okay. Ah, perfect. Thanks, Brad. Sorry, keep in mind, my video is about 10 to 15 seconds behind the chat, so. All right, Alex J says, based on my understanding, investing is the same as trading, just a higher time frame. If we are investing in crypto markets for the next 1 to 2 years, do we have enough technical information to help determine entry points, or is there not enough information to go higher time frames to it? No, you can absolutely do that. So, if you are looking at a weekly basis, right? Let me go to one of my crypto lists here. Bittrex. There you go. Okay. So if we are looking on a weekly basis, if we get a good solid or W in, and we've got divergence in play, right? And we're in a good location, there's no reason, and we have the FA that we need to get in, right? There's no reason we couldn't get in on a weekly trade that might take us a year or two to resolve. Now that's super long time frame. You have to have super patience because it's going to go up and down that whole time, right? But there's no reason at all why you can't use this as on like an investor time frame. Okay. Okay, so I guess you guys are feeling teased. I apologize. So the way that I handle risk, okay, I start with 0% risk, i.e., no risk. I'm not going to get done on the trade. Okay. FA screener. So I have different screening scores that are minimum thresholds and exceptional thresholds, but let's just use crypto for this, okay? So I go plus, say I've got 5 factors, right? Plus 1% risk. I'm willing to risk 1% on this trade at this point. Then I look at location. Different setups have different thresholds, but let's say I have an exceptional location, okay? And I'll talk about what they mean with different setups when we get into them for setups that I have, right? So I'm at a percent. Now I'm at 2%. I'm willing to risk. Now I still have to meet all the criteria, right? So then I have momentum. Momentum is acceptable, but not excellent, right? Plus 0% risk. I'm still at 2% risk, okay? Then I look for price structure. And price structure is okay. It's a W, but it's not really wide. I've got different factors that come into there, okay? At 0%. I've got all my factors I need to get into the trade, but I'm going to risk 2% on that trade, okay? That's how I factor in my risk. Make sense? Now, that's not a TRI thing. That's just a Grim thing. But, you know, that's how I control the risk in my trades. So Brian brings up a good one here. All right. So we just had a setup, right? This was a setup, specifically the bot. It hit its target objective. So ultimately what we want you to get is being able to see this setup. So the bot setup is very specific. You have to retrace a specific amount. It's not Fibonacci levels. It is between 33% and 66%. You have to get 3 successively higher lows. He has one here, one here, one here. Then some kind of market structure to get into the trade, right? So he's looking for a W after this third low. He's looking for a W to get into the trade, right? Now, can you see the W that confirmed where he got in? Brian says if it's a Grim thing, it's a TRI thing. Fair enough. Fair enough. Varg says, perfect. Do you normally write it out before doing the trade? Absolutely. So when I have a bunch of like templates that I have set up in Notepad that you can't really see because I'm only sharing my browser, but let me paste it in here. Hang on a second. Here's my vetting document. Okay, so when I do a setup, right? And I think it's a good idea for all of you to do this at least initially, if not all the time. All right, I've got this template I use. I explain what setup I'm using, right? I list what factors I have for my location, and I put in whether that adds a percentage of risk or not. For momentum, I actually look at 4 different things, but they all count as momentum. So I have a kind of a specific thing I use where if I have to have at least 2 of these things in agreement on momentum for me to get in. We will learn about Willie, we'll learn about the volume study and MACD, and we've seen RSI already. So I need at least 2 of these to get in. If I have at least 3 of these, then I will add a percentage of risk for my momentum section. And then structures, kind of specific, and I'll show you what I mean by that. But and then I'll put like my entry point. I will often put my take profit level and my stop level. And you'll see when I post charts, very often I have it written up like that. And part of the reason I do that is I have a terrible memory, right? So if I don't have this, and so I take a picture of this and I put it in my log. So if I don't have this, then I don't necessarily, like, it takes me a long time. I have to recreate the whole thing to remember why I got into the trade and what the factors were. Okay. So I absolutely write these up when I do my trades. And I think it's a really good idea for you to do so as well. So I see you guys are talking about opportunity cost and being in trades, that sort of thing. People have different approaches to that, right? And they're trading in different categories and with different goals. So it's important to be consistent and to have considered that. But it's also important to note that even the money you haven't invested. So this is the reason I bring this up is this is one of the tricks our mind plays on us. Bear in mind when we're trading, right? When you get into a trade, your brain releases a huge rush of oxytocin, right? It's a huge it's drug, right? It's a happiness hormone. It makes us happy that we got into this trade. We took the risk. It's how we're wired, right? We are risk-taking animals. Even the least risky of us is a risk-taking animal. And we will seek that out. And one of the things our brain tells us is tied to opportunity cost. Okay? Our brain tells us, well, if you're not invested in this, then you're losing money. You need to do it. What your brain's telling you is that it wants another dose. Okay? It's really important to know that. That's a really sticky area. Now, I'm not saying there's not opportunity costs. But what I'm saying is don't overplay them in your mind. People do all the time, right? I see this with new traders every term. When I do my private tutorials, I see this a lot, right? One of the reasons that drives FOMO, right, fear of missing out, is that idea of opportunity cost. So it's important to keep in mind when you keep your money in cash, it's still in a position. Okay? It's still in a position as cash, as US dollar, or as Bitcoin, or wherever it is. Don't worry so much about making sure you're investing all of it. In fact, it's one of the things that's really important as you get into trading. Something I highly recommend is you need to keep a certain amount of your stake in what we call dry powder. Okay? If I am, and the way I determine that is if I am trading a leveraged asset, okay, so if I'm trading futures or if I'm trading forwards contracts on crypto, I keep at least half of my account in dry powder, 50%, right? That's my threshold. If I'm trading options, which again we won't get into, but I keep 50% of that in cash. If I'm trading stocks or non-leveraged cryptocurrency, I keep about 25% is my threshold of capital. It's actually 30% is what I keep, but I'll let it dip to 25 before I start pulling back, right? So 25 to 30% is what I keep of my stake in my base currency when I'm trading non-leverage assets. And the reason, there's a couple of reasons for that. You need to be able to tolerate a series of losses, right? And if you've got everything invested and you have a series of losses, the inclination to pull things out of position, pull things off out of position, is going to be really high, and you don't want to do that, right? So you've got to be able to weather those loss streaks. Also, the other big part is, say there is a big fundamental event that was unexpected, a black swan event is what they call that, right? If there's a big black swan event, you want to be able to take action on that. And so I have it written in my plan. I keep out 50% of my cash, but in the event of some big major black swan event, I'll let my leveraged account dip as low as 30%, but it has to be justified by a major fundamental move. Okay? So there's a couple reasons to keep that in cash, but I just bring that up because when people start talking about opportunity cost, very often that's a very slippery slope into over investing and kind of over trading. Okay. All right. Sorry, I know that's on a side, but it's a very important thing I need you guys to understand. Your brain will try to make you trade excessively. Okay, so Max, you ask, you're confused if there's divergence between price and momentum. Isn't that a fail on the setup? It depends on the setup. If I am trading a trending setup, I want momentum to be convergent because I want it to keep moving. But if I'm trading a reversal, right? If what I'm doing is trading a long trade to come up from a trend, a bearish trend, then I want divergence. I want price to be going lower while we see momentum building, because I want to get in as soon as it breaks out, right? So it really depends on whether you're talking about a ranging trade or a trending trade. It does. So trading is pretty much track. Kind of. Yeah. It's really, really important to get that that your brain will try to trick you into giving it more drugs. Rem says, I don't see the W on the Litecoin chart. You asked if we could see the W. Let's see if Brian highlighted it later on, because I'm back a little ways in time. Alex J, I've done this in traditional markets and trying to come over into the crypto markets because of the huge opportunities for gains. Yep, absolutely. Brian did highlight it. So, let me paste that in here. All right, so Brian highlighted the W. You see how the W was forming here, but it didn't confirm. And this is the key part. The whole W didn't happen after this third high. I'm sorry, third higher low. But it confirmed here. When we crossed this line was where it confirmed. Okay? So the signal fired here. Now, personally, where I like to enter a trade, and we'll get into this when we do our candlesticks course, is the bottom of that confirming candle. So this candle here, I would have put my bid in here, and it would have gotten filled here. Okay? But that's because I'm a cheap ass. Yeah, and Alex points out you can use the TradingView replay function to go back in time to your favorite asset and play on one candle at a time to see the spot that developed. Absolutely. Let me show you a little bit about how that works too. So if we wanted to do a more fun asset, let's do Litecoin. All right, so if I can find it, well, let's just do it this way. LTC USD. Let's look on Bitstamp. Let's go to daily. Okay, so I'm going to move this to candles just so we can see this a little more clear, right? So what we can do is if you come up here, there's a replay button. If you hit that, it's going to give you this red bar. This is where you're going to select where back in time you're going, right? So we could come here and it's going to show it from that point, right? This is what it looked like as you were getting into it. And then if you hit play here, it's going to show you. You can slow that down. Sorry, I have that at like max speed. Let me get out of here and fix that. Replay, back here. Let's slow that down, right? And you can play out each candle, right? This does one more every 2 seconds is where it's at right there. You can see that. This is a really cool tool in TradingView. I absolutely love the replay tool, right? Colleen asks, or well, Varg says, but for crypto, BTC is cash, kind of, and Colleen says, including BTC is dry powder. So that depends on your setup, which really depends on your trading plan. So we are at a point where if you're trading on an exchange that has both US dollar and crypto, US dollar could still be your cash king, right? For me, my trading plan, I want to accrue Bitcoin. That's a trading plan I've had in place. And so BTC is considered my base currency in my crypto trading plan, right? So when I say I hold 50% of my base currency, I'm holding 50% of my my money in Bitcoin, right? Not in a position, just sitting in a wallet, because that's for my leveraged crypto account. Now I have multiple things. So I have my leveraged crypto account, right? That's where I'm trading on BitMEX, and I'm trading on Deribit with that. And then I've got my little old lady account. So that one is primarily Bittrex and Poloniex. That one I hold 30% of that in Bitcoin, offline on a wallet. And then I do the rest of my trading there. Okay. So Brian does point out it's kind of dangerous since Bitcoin's in a downtrend. I've been using the downtrend to cost average buys in as we went down, so I don't have as much of an issue about that. But it's really about what's in your plan as your base currency, right? And as Brian says, what he loves is when you get a W that aligns with bot levels. Now, in my particular version, my variant of the bot setup, I also require momentum convergence. So I want to, like for a bullish bot, I want to see a bullish trend in momentum as well. All right, so I think we're caught up. All right. Okay, so once again, I want you to look on weekly charts, look for transitional patterns, triangles, M's and W's, heads and shoulders. I want you to look and see if you can see convergence and divergence building in each of these charts as well. And then, and this is just personal, right? I want you to think about what intermarket analysis relationships would help you with your kind of asset class and assets of choice. All right. So, in conclusion, so we talked about technical analysis. We talked about different schools of technical analysis: price analysis, indicator analysis, right? Intermarket analysis. And then building your TA tool belt. Okay. All right. Now let's take a look at the quiz. I think that's probably the next course order. All right. And I should be on exactly the same stuff as you guys. Let me know if you don't have 20 questions in this quiz. I think from now on we should all be in sync. All right. There are how many primary schools of technical analysis? There are three, right? We talk about price analysis, indicator analysis, and intermarket analysis. I'm glad. I worry a little bit when we get into a lot of back and forth that people are getting lost or confused. So, Alaska, I'm glad that it's getting your head wrapped around it. And guys, please don't hesitate. You haven't been, but please don't hesitate on asking any questions. My goal here is to get you guys fully up to speed by the end of level 1. All right. So, what I want is for you to really understand this material. All right. The Dow Gold ratio is an example of what school of technical analysis, right? Just talked about the 3 different schools. This is an intermarket analysis, multiple different markets that we are comparing to each other. And then the 2 primary market states are ranging and trending, okay? And markets tend to range about how much of the time? 70 to 80% of the time, markets are going to be in a range, not in a trend, okay, on a given scale. And the term used to describe the changed market from one state to another is called what? This is called market structure. This is the term used to describe, I don't know how to put it, the patterns that indicate change in a market state from one to another, right? Market structure. Thanks, Varg. I hope I'm doing right by you guys. So, not to talk myself down. That's not really my thing, but I just want to make sure that you're really getting it, and I don't want to get too caught up in ego. Okay, so please, by all means, give me feedback. Let me know if I'm not clear about something or if I'm confusing. Please let me know. All right. The 3 primary trend change formations taught in this course are, where's that? M's and W's, heads and shoulders, triangles. All right. Indicators measure what 2 internal technical gauges. So indicators measure, and they don't always measure both of these. This is really important. They measure oscillation and momentum. All right. And an indicator is said to be in what when it is not making new highs, but the price of an asset is moving to new highs. It is said to be in divergence. All right. Technically speaking, 2 stocks that move very closely in price are said to be highly correlated. Correlated is the word we use for that. That's just an industry-wide term. And then stocks and bonds usually move in opposite directions, which means they must be inversely correlated. And then which of the below is an intermarket analysis relationship? All right. Dynamic yield curve is intermarket. Futures term structure is intermarket. Dow theory, and so futures term structure is where we're looking at the futures spread between the futures and the spot price. Dow theory and market breadth, so all of the above. And then technical analysis is a proxy for what? And this is really another thing that's very important and often gets kind of forgotten about as you dig into analysis. It's a proxy for supply and demand in the market. Okay, all it's telling us at the end of the day, price is telling us about supply and demand. And technical analysis works best in absence of new fundamental drivers. And technically speaking, why do markets range between 70 and 80% of the time? And the reason for that is, again, going back to the idea that it is a proxy for supply and demand in the market, you reach an equilibrium between supply and demand in a given range. And once that's been identified and there are no new fundamental drivers, that's where we see this ranging happen. And what technical indicator? Oh, what does the word proxy mean? Proxy. Almost anything else I'd use is kind of an idiom. A proxy is something that represents something else, right? So supply and demand are specific concepts, but the price movement of an asset can represent those levels of supply and demand, right? That's what proxy means, to represent something else. As Brian says, to vote for, yeah. And then what technical indicator do we use to confirm market structure and patterns, such as heads and shoulders, M's and W's, and triangle patterns reviewed in the course material? So we didn't go into this a lot during our discussion today, and we have a whole week that we spend on this, but we're talking about volume here. Volume is a great confirming indicator for things that we see in the market. And then one of the key uses of indicators and the concept of divergence is to tell us about what? And that's to tell us about future price action. What we're trying to do, not to put too fine a point on it, is see the future, right? When we see that divergence building, that gives us an indication of where things are going to go in the future. Here's that word again. What is the ultimate fear proxy, as well as a good sentiment indicator to be aware of in the market? That is the US dollar index, right? How do people feel about the US dollar is a really good indication of the amount of fear in the market. When people are afraid, they will go to the dollar, they will go to hard assets, right? And it is a really good sentiment indicator. And then in building your TA tool belt as a trader or investor, what is one of the most important concepts to understand? That is, it's all about personal fit. You have to have confidence in your tools, right? It's not exact. When I say it has to feel right, right? I don't necessarily mean behave from emotion, but what I do mean is you need to have confidence in it. This is a huge part of why we want to paper trade, right? We need to have confidence that what we're doing, what we're looking at, is going to give us an indication, right? Until we've developed that confidence, it's not useful to us. And then the definition of an uptrending market, also called a bullish trend, is higher highs and higher lows. Conversely, the definition of a downtrending market, called a bearish trend, is lower highs and lower lows. All right, so that was the quiz. Let me now move on to our Q&A document. I'm sure there's a lot in here. All right. What are some assets that go up in value when the stock market crashes? Well, we've talked about the inverse correlation between stocks and bonds. So you can imagine bonds will go up when stocks go down. In a true crash scenario, we're going to see the US dollar index get a lot of money driven into it, right? As people pull their money out of the stock market. If you look for, and you can just Google on this too, if you Google for things that are inversely correlated with the SPY, or the S&P 500, when we see a stock market crash, we will often see things that are inversely correlated or have a negative beta moving up. And how many highs or lows, higher lows or highs do we need to establish a trend? Do we count wicks as well, or only candle bodies? Does the whole candle need to be closing above the trend line to neglect it? Actually, let me step back a little bit here to question number one because Brian had a good point. So, short-term government bonds are the flight to quality proxy during crashes in the stock market. So it's not. Keep in mind when I talk about bonds, there are different duration of bonds, right? Specifically, we're looking at short-term government bonds is what we typically see go up first when we have a stock market crash. Mr. Alaska asks, how is the index measured? How do they know how much we have in our accounts? So, as Brian says, it's a bit of a tinfoil hat conversation, but something you can use is the DXY. So that's the US dollar currency index, right? And that's going to give you an idea of the value of currency. It doesn't really tell you necessarily how much is moving into cash, but it's going to tell you a bit about the value of the dollar. And then, all right. So, how many higher lows or higher highs do we need for a trend? So, let's talk a little bit about M's and W's. Okay. So, what we're trying to establish with an M or a W is a trend. We're trying to establish in a bearish trend, like we just have this. Let's look at this, okay? Let's look at this from a weekly scale, right? We have here now, technically speaking, just to be completely precise, I would not call this. Let's go back to the daily. I would not call this a W yet because we haven't broken above the wick with a candle body yet. Okay. But you can look here, come down to this wick, or down to this tail, up to this wick, down to this tail, right? We are certainly making our way towards a W. And that should tell you something about the dollar, right? The dollar is probably going to be going up in value. Now, as I said, I don't consider this a W yet because we haven't closed above this level. But yeah, like Brian calls it out here, DXY is putting a W in here. What does that tell us? Risk on or risk off, right? Risk off. People don't want to take the risk. They want to be safe. They want to be in the default currency, right? And then the other question he puts out here is Bitcoin a risk-off asset or is it a risk-on asset, right? Yeah, absolutely. Right? Economic cycle, growth, recession, recovery, peak, right? Where do you guys think we're at? Right? Up here. Is there a W in RSI? Yeah, I would call this a W in RSI. Absolutely. Right? We have here, 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 here. And we broke above it. Absolutely. Right? So technically speaking, right, what do we see here? We have had a down here, right? Oh, let me go the other way. Hold on a second. Hold on, I'm doing this backwards. I'm confusing you all. All right, so what we want to see here is got this in terms of divergence, right? We've also got this. We don't really have divergence. We have convergence. Higher lows, right? When we were making lower lows, we were making lower lows here. So we don't really have divergence that we can talk about, unfortunately. But we definitely see a W in RSI, and we see potentially a W in price. Why does it have to close above the previous level to confirm it's going down? Alex, I'm a little confused about what you're asking there. So what we're talking about here is a potential W. W takes us up. It's a bullish signal, not a bearish signal. Right? So if we can break above this level, that would be at least one indication of a move up in the US dollar index. Okay. So there are some other questions here. So how many highs or lows do we need to establish a trend? Well, we need at least 2 higher highs and 2 higher lows, right? Preferably, the more we get, the better. But I think at a minimum, we would need 2 higher highs and 2 higher lows, or 2 lower highs and 2 lower lows to establish a trend. Do we count wicks as well, or only the candle bodies? So we'll get into this. There's 2 schools of thought on it. So, for instance, in the daily brief, you'll see Thomas and Brian have 2 different ways of doing this. Brian and I both count wicks and tails. Thomas likes to go off just candle bodies, so just clotheslines. Okay? There's 2 different ways to do that, and we will get into that in a future week. Right? Week 7, we will talk about candles and candlesticks and what these parts of the candle mean. And then you can make a decision. Whatever way you decide to go, you should be consistent about it. But it can incorporate the wicks and tails, or it may not. Right? So, for instance, from a clothesline perspective, we have a W. Okay? Come here, candle body. So if we were just going off candle bodies, come here, we have a W. Okay? But I work off of wicks and tails. Since I work off wicks and tails, but I need a close above that middle wick, then we do not yet have a W on the DXY. Hopefully that makes sense. Does the whole candle body need to close above the trending line to neglect it? For example, look. Trend there. Yeah, so I wouldn't count these as breakouts. We don't have a close above there. So I think that answers your question, that we do need to see a candle body close above the, for a bullish, we need to see it above the midpoint of that W, or below the midpoint of the M. The candle body is what I'm looking for, because we need a close beyond that. Not necessarily. I would say rather that the candle body. Oh, Brian answered it. I would say the candle body approach is the more conservative approach, because with wicks and tails, you have a lot more movement, right? And so you'll tend to see structure come in more solidly. In this particular case, the more conservative approach tells us there's a W. But this is a kind of a specific instance where this is the case. Normally speaking, going off candle bodies is going to be a little more conservative. All right. Am I thinking right that if we have doubts on what is a general trend, because you can make cases for smaller trends inside bigger trends, we zoom out to a higher time frame to see the trend clearer? Absolutely. Absolutely. One of the phrases we use, one of the catchphrases, is when in doubt, pull out. Right? When in doubt, move to a higher time frame. So this is a daily. If we're in doubt on this, move to a higher time frame to see what does the rest of this chart look like, right? All right. Question 3. This might be a long session. Sorry, guys. I know we're already an hour and a half or 2.5 hours in, but I'm just going to work through the rest of this, which is quite a bit. But I want to make sure you guys get all your answers. Sudur says, so during a recession, commodities to the moon, equities underwater, right? Nope. Commodities are risk assets. Right. So during a recession, we're gonna see bonds, we're gonna see U.S. dollar go up. Did I say that commodities are risk-off assets? Oh no, okay. No, you're fine. No, it's fine, Brian. Please, by all means. Yeah, that's what I think. What we would expect, Shador. All right. Number 3. Should a Head and Shoulders have the same level for drawing the 2 points for the neckline? Does it differentiate from triangles? Same for a double bottom. All right, so for a Head and Shoulders, I don't think I have a good Head and Shoulders. Oh, I do. Right. So Head and Shoulders. If we were to draw a Head and Shoulders on here, right? We were using this as our Head and Shoulders. Okay, left, down, up, down. So I would not like this for a Head and Shoulders, okay? Because ultimately what we're trying to establish is a given resistance level, right? Ideally what we want is something close to a horizontal line that we are testing against. We test a given resistance level, we test it again, and then test a third time and we break through. I think of a Head and Shoulders as a expanding wedge followed by a descending triangle where you have a flat bottom and lower highs that ultimately break through that triangle. Okay, so it's not a hard and fast. If it's a little tilted, that's not necessarily the end of the world. But yeah, Brian, I'm trying to avoid saying support level because I don't want to get too much into horizontal resistance and support. But what we're looking for is just that. We're looking for a horizontal resistance level, well, support level in this case, that we're going to break through. If this were an inverted Head and Shoulders, we'd be looking for a resistance level that we were going to break through. Okay, so the flatter the better for Head and Shoulders. Yeah, as Brian says, flatter the better. Same for double bottom and top. Well, not exactly the same. So I actually want to see because again, we're trying to define a trend, right? So higher lows and higher highs for W. So with the double bottom, I actually want to see that right-hand bottom a little higher than the left-hand bottom. I don't like it way up here, right? I still want it to look more or less like a W, but I like it a little bit higher. Because what I want to define, again with resistance levels, I want to define resistance level here, another resistance level here. I keep calling resistance. Support level. Yeah, I do have this bug. Support level here, another support level here for my W, right? And then breakout. Because each of these support levels kind of makes it's difficult to move through. For reasons like are beyond level 1, they provide protection for my trade. Okay. Yeah, and the other way if it's inverted. If we're looking at an M, so say instead of this W, right, we were looking at the M that came in here, right? here, down to here, up to here, breakout. I would like to see that right hand lower than the left hand. Again, this is a bit steep. I like it to be a little closer to it, right? It's kind of specific levels that I like to see, right? I'd like to see, this is probably way too much, but I'd like to see this come up into kind of a reload zone of this move down, right? Just about here, and then a breakdown. But we'll get into reload zones and location later. See you later, Art. You're very welcome. Right now, this isn't this isn't account restricted, but as soon as I wrap it up, I'm gonna apply that. So if you can't view it for any reason, PM me. Make sure I have the list of everybody's emails they log into YouTube with. But if for whatever reason, please message me. All right. And since I said that on the recording, anybody else, if you notice that anybody's having trouble getting in, just tell them to PM me. Yeah, I don't love this M. You're correct. Really, ideally, Owen pointed out that the midpoint was lower, so really it'd be more like here to here to here to here. I don't love this M. It's the example I could see first. Yeah, no, I'm with you. I get what you're saying, because before I drew it from here and that midpoint was lower. I'm not saying that's not at all an M, but that's not the kind of M I really ideally want to see. Right. All right. Do we have data of the highest success rate for setups based on what different criteria from unrelated reasons do we use? Okay, you kind of lost me. For instance, does setup using fib, reload zone, MACD, and W breakouts have higher success rate than setup using fib, reload zone, RSI? Well, no, I don't have a pile of data to work off of. I just have my own data, right, on my own setups. Some people have done back testing for various indicators. The problem that I've seen with people that have done extensive back testing is they'll test one indicator, not a collection of indicators. And it also requires that it be automatable in order for them to back test it, right? So in my experience, what I have seen is when we have a reload zone, we have divergence and a W breakout. I've averaged about somewhere around a 68, so that's basically our 3-step setup. There's some other things that factor into this, but I've averaged about a 69%, I want to say, might be 70% success ratio on that over the last, in 2018. So I track, I have a log that's similar to the shared log where you specify what setup you used, and then you can see what your win and loss percentage with that setup is. So, but I didn't, for instance, do that separate from RSI or separate from other things. I haven't done that study. Well, I show this. Sure, and some of the setups are already in the library, right? If you come in here, right, the L-Tanganator is the setup I was just talking about. We also call it a 3-step setup, which is here. They're very similar, right? And so if you come into the library, you can look at what it constitutes. Step 1 is location, talks about where that is. Step 2 is momentum divergence, and then step 3 is looking for price structure. Okay. So So we have a lot of these setups in here. We will also talk about them in class, and we're going to go through a few of these. So the setup that I'm going to have us building as a group is basically our 3-step setup. Once we get into location in a couple weeks, we'll start building that, and we'll kind of walk through the building of that setup and how it works. All right, is BTC dominance a good intermarket indicator? Let's look. No, I can't open it. You didn't give me the shared link. And then looking pattern breaks to see where the dominance is going. Looks like we got a conversation on W's in here. So for W's and M's, something we can talk about here is, so Brian is, I just got done saying that I like to have it a little higher than the other one. Brian's pointing out the closer the better. Those 2 statements aren't at odds. I prefer not to have them be at the exact same level, because I would like to see 2 different support levels on a W, resistance levels on an M. But I do want them close, right? I have some kind of specific numbers around it that I look for. I like to see it somewhere, ideally, the higher it can get while still being less than an 0.886 level, the better. But I'll take it. I'll take a W if it's the same level, right? But that would be a sufficient W, but not one that I would add a percentage of risk for. A W where we drop down to about the 88.6 level would be one anywhere between 78.6 and 88.6. I would consider a +1% risk for that market structure. That's the math I use in particular, because I do like to see separate resistance levels or support levels, but we do want those pretty close, right? BTC dominance indicator. Okay, let's take a look. I'm not really that familiar with BTC dominance. I don't know what that is telling me. So I can't really answer that. I'm not really familiar with that that measure. Okay, so Brian points out, so some examples of good and bad W's, right? If you look at my chart here, right, this W, change the color on this. This W, not that good, right? It's really steep. Doesn't really, while we do have a trend, these are so far apart as to not really be, not to give us a good idea of resistance, right? Sorry, support. God, I blame Thomas. Not give us a good idea of support. Whereas over here, these are pretty close, right? They give us a good idea of that support level. All right. Sorry, I got a question here. Max says, for failed trades, is it easy to find the reasons why it failed according to your setup? Usually. Excuse me. Sometimes the market just doesn't move the direction that you thought it was going to. You might have a perfect setup, everything looks great, and then the market just moves the other way. The catchphrase I always think of is Brian saying, well, the market does any damn thing it wants to do, right? Sometimes it's not going to pan out. and you didn't do anything wrong. You executed it fine. The setup's fine. It just didn't work. It's going to be that way, right? This is not a sure thing at all. This is about giving us the best possible foot forward. But that's part of why we risk less than 5% too, right? Some things are just not going to work, even if they work a majority of the time. What I'm more concerned about is looking at the trend of your failure or success. If you've got 40 trades that you've done and you have succeeded with 75% of those, then that is less concerning than if you have 40 trades and you have only succeeded with 50% of them, right? If you're only succeeded with 50% of them, then you need to look at what's happening, right? Am I following the rules every time I do the trade, right? Did I not win on that 50% because I didn't follow the rules correctly on those? Or did I follow the rules, but the rules aren't working, right? So, for instance, setups that have been vetted and we put up on the site, like the bot, right? We know that those work for people at least 66% of the time. There's a lot of people that have vetted those. So if I'm using the bot, and this occurred to me, by the way, in level 1. Initially, I started using the bot, and my win rate sucked. It was like 40%, right? So I look at that and I go, well, a lot of other people are using it successfully, so I must be executing it incorrectly. And I was. And I identified what it was that I was executing incorrectly. I had a fundamental misunderstanding of, well, a few things, but mostly, this is way at the beginning of level 1, right? I had incorporated divergence into my setup, but I was using it incorrectly. So that tells us it's an execution issue, right? But if it's a new setup we've just created, if we have vetted a few other setups and we know what we're doing and we're fairly comfortable with it, and we're sure that we're executing it correctly, but it's still only winning like 50% of the time, well, then we probably need to include some other factor into the setup to give us a higher probability. Yeah, Mr. Leska, the bot is a trading setup, right? If you come into the library, the bot's here. Brian even did a video on how the bot works, right? So, it's a specific setup. Brian gets this question all the time. I remember I asked this question too. Everybody asks this question. The bot doesn't. It's not an acronym. It doesn't stand for things. It's just if you trade using the bot, it's so specific that you're going to end up trading like a robot, right? All right. How do we plot the 4 intermarket analysis charts in TradingView? All right. So what you can do, brief little one-on-one here. I don't know if so. I have like the highest paid version of the TradingView account, so I can do things in my TradingView other people can't do. I don't know if a multi-chart setup is available to you, but if it is, in your chart you come up here to select layout. There are different layouts that you can see here. If we do the 4x4, in here we want to sync. We don't want to sync drawings between them because we're going to be different assets. You may sync the time between them. Crosshair doesn't do us a lot of good, right? Time and maybe interval, right? That way if you change the interval on one, it's going to change it on all of them. So if I come here and I go weekly, makes them all weekly, okay? Then you can put your whatever indicator you want, or sorry, not whatever asset you want, or correlating asset into each box. So this is this one. When you have this selected, it'll be here. So I could do, these aren't intermarket, I'm just picking random assets, right? SPY, DXY, right? You can put different things in each of these. All right. It's pretty cool. I don't know how much that is available to like a free account on TradingView. Excuse me. I see how the market structure represents the battle between supply and demand in the price chart. Excellent. But I don't get the idea on why we're looking for M's and W's in the indicator lines. Well, so what we're looking for is trends. And I may have, this might have been written before we did today's group tutorial. But what we're looking for are trends in momentum versus trends in price, right? The split things aren't available for TV. Sorry, man. So you may just need to look at your intermarket indicators one at a time then. All right. So the reason we're looking for M's and W's on indicators and all the market reversal patterns is they give us an idea of the trending and changes in trending on the indicators themselves, right? So if you're looking at RSI, the relative strength index, it shows you the strength of the asset in which way that strength is trending, right? All right, I hear Brian talk a lot about divergence on his daily brief. Does it mean we are mostly looking for the coming change in the market state instead of trying to find convergence and jump onto the ongoing trend? It really depends on where we're at. Since about 70 to 80% of the time markets are ranging, do you understand how it makes more sense to look for divergence? So we can identify when we're at the edge of those ranges. A majority of the time. Now, sometimes we're going to be in a strong trend. If we're in a strong trend, then it makes sense to hop onto a trending setup like the bot. And not in all trending setups, but like in my version of the bot, I actually look for momentum convergence instead of divergence. So hopefully that explains some of that. A majority of the time we're going to be in ranging markets. So a majority of the time you're going to be looking for a setup where you are looking for a reversal. So in a reversal scenario, you want a divergence, not a convergence. What do we got here? Oh, nice. So Alex has some intermarket analysis chart sets that you can go to the link and probably view, even if you can't build them in your own trading view. If you have like the free trading view and you can't do multiple chart layouts. All right. How can we see when establishment of an uptrend is accompanied by larger volume? Is volume confirmation one of the unrelated reasons to take a trade, or is an integral part of price structure? So it's not part of price structure. Did I get rid of my volume? Let me put it back. So volume, oh, it is on here. Oh, I'm just not. Where's my volume? It's weird. All right, bear with me, guys. And what happened with my volume here? So we do a week on volume studies, where we are specifically what? Oh, my trading view is being weird. Because of the asset I'm on. Ah, there we go. Okay. All right, that was really weird. Move to existing payment. Okay. Maybe it's the asset I was looking at. That was weird. All right, so volume. When we are looking at volume to help us confirm a MRW, right? So we have an M that came in here, okay? And it confirmed midpoint there, lower here. I guess it didn't really confirm to like here, not there, one next to it, here, okay? If we look at volume, volume consists of bullish bars and bearish bars, right? We were looking at NIM, so we're looking for bearish confirmation. What we want to see is a spike up in the bearish bars. So you see how this way. I have a really hard time drawing the little like caps that Brian does. I don't know why, I'm just retarded at it. But you see how right there we have one high, right? Then over here we've got a higher high, right? And over here we've got a yet higher high, right? This is part of the volume study that you're going to learn when we get to the volume study portion. And that's what can help us confirm that the bearish move is going to happen. So we have a big spike up in bearish volume. Okay? Excuse me. All right. Can we reduce triangle patterns to M's and W's, or is it essential for future trading we recognize them as triangles? Well, I think it's important to recognize them as triangles because a triangle can break to either a W or an M, right? So it's important to note and recognize when price is consolidating smaller and smaller. We call that that it's coiling, right? That's coiling tighter and tighter. It's important to recognize that because that's going to be where we are expecting a breakout. And then we need to look at other factors to see which way do we think that breakout's going to happen. So I think it's important that you recognize the triangles and the different types of triangles. Symmetrical triangles are that coiling there. Descending triangles are really important because you're talking about bouncing against a support level. I got it right, Brian. Support level. Ascending triangles are important because you have a resistance level that you are bouncing against, right? So these are all important patterns to learn to recognize, right? M's and W's are huge, but it's also really important that you get the interrelation between an M and W and a triangle. All right, we're going to go into more pattern details later on. If so, if not, how do we treat W on higher time frame when the same W on lower time frame has a different midpoint? So that will happen pretty frequently. One of the things that's important when you're doing your setups is that there are certain factors that don't change between time frames and certain factors that do. Location typically does not change between time frames, right? It might change a little bit because you might have orders that show up in a lower time frame that don't show up in a larger time frame, and I'm not sure why that occurs, but it does occur. But location I typically look at on a larger time frame to give me an idea of where a reload zone is. We'll talk about that in a couple weeks. But when we're looking at momentum and price structure, we want to look at those on the same time frame. So we want to look at divergence and price structure, so M's and W's in price, reversal signals. We want to look at those on the same time frame as our divergence. Okay, so whatever time frame that is, if it's a daily, we want to look at all of that on a daily. If it's a weekly, we want to look at all of that on a weekly. It's less important which time frame you pick. It is more important that you do all of your setup on the same time frame. And are we looking at only candle bodies, draw patterns? We will get into candlesticks later on. I look at the entirety of the candle, entire range of the candle, not just the candle bodies when I'm drawing patterns. Thomas, for instance, prefers candle bodies. And then does the whole body of the candle have to close above the midpoint for the W confirmed, or just the candle? I just said that I use wicks and tails, but that clothesline is really important to confirm your W. So your candle body has to close above the midpoint, even on my system, in order for the W to be confirmed. Please go into detail exactly on how to use the volume bars. So I went into that just a little bit ago. We'll go into a lot more detail when we get to the volume study. We're going to spend a week on this where we go in depth on how to analyze volume and OBV and how those things work together. Okay. So we will give you the tools to analyze volume, but we're not going to do it right now. We're going to do it in a few weeks. All right, how do we tell if the descending triangle pattern will lead to a bullish trend or a bearish trend? I think I've seen people using it for both. So the triangle patterns in general, right, can break both ways. A descending triangle where you have a flat line can break south if it can bust through that support level. But if that support level holds, if we reject on that support level, then we're gonna, we're not gonna go down. It's what you want to look at is again, we want to have 3 reasons for your trade. So we want to have multiple reasons that are leading us to suspect it's going to break, but ultimately you're going to have to wait for the break before you take the move. There's another inclination when it comes to trading that you need to be aware of, and that is people will want to do what we call front running a trade. Okay, that's where a triangle is building and they go, I'm sure it's going to break this way, and they get into the trade before they have confirmation of that break. That's a very, very dangerous thing, and we don't want to do that. Okay, because it can break the other way. Our thesis could be wrong. We don't want to capture the absolute top and the absolute bottom. What we want to do is let the big boys put that in, and then we want to ride their coattails. In other words, we want to see the breakout happen, get it confirmed, and then we want to get into the trade after that breakout has happened. Okay, so the way that the short version of this is the way we know whether it's going to be bullish or bearish is when it does it. So, and then how far up or down is the target for W's and M's? So unlike a Head and Shoulders, where there's kind of a built-in idea of a 2-to-1 move when a Head and Shoulders breaks, when a W or M confirms, we actually look for other things to give us the idea of how far we're going to go. For right now, for the purpose of what we're doing with our paper trading, just assume a 2-to-1 risk. And what I mean by that is if we get an M that comes in, so say we are using this M, right? And we really kind of get to go off here. There's a terrible M. Let me find a better M for you to use, or a W. I don't care which. All right, so hang on. Let me find a different asset. Was that SMH we were on earlier? Halfway decent. All right, so this W. Let me replay back to here. Okay. So we had this W that confirmed on this candle. Okay. What I'd like you to do in this case is just note where the W closed. We need to come here. We need to risk to the bottom of that W, and then we're just going to put our target at the 2-to-1 level, and let's just see if it worked. Okay, so this isn't ultimately what you're going to be trading, though ironically, look at that, hit that and it's bounced down. So that would have worked, but this is not how we're going to be determining our ratio, just a 2-to-1. What we're going to be basing it on is the move down from the previous move, and we'll get into that in a couple weeks when we do location. But for right now, just do a 2-to-1, right? And let's see what happens. How do you personally organize all the correlated assets web links, sites, etc. Well, I've got kind of my own system that I use for things, right? Everybody does. But I have like core assets in each of the sectors that I look at in here. I've got an account on FinViz, which you can do a free account on FinViz, and if you do, you can save your screeners in here under your presets, right? So kind of got my default screeners in there. Other than that, I organize them in my folders, right? Can we talk a little bit more about RSI? Well, I think there's actually a really good video on RSI. I don't want to get too much into it right now, because we're already well over time at 3 hours and counting. But I do want to point you to it. Videos. I'm sure we got some on here. I could have sworn we had one in here. I'll look for a write-up or a video that we've done on it. I swear we've done a video on RSI. Maybe I'm thinking of one of the old videos Brian did, but I'll look for it and I'll put a link in here. And then, being rational investors, should fundamental analysis always be one of the 3 reasons we take for a trade? Well, when we're talking about our 3 reasons in this week, we're talking about technical reasons. But I also only trade assets, like I talked about earlier, that have passed my fundamental screeners. So, in a sense, yes. Then Coinigy links. Thank you. All right, let me go back there. Aha. I don't see it. There we go. Thanks, Brian. All right. There we go. Okay. In TradingView, how do you plot the Dow versus US dollar, Dow versus New York market growth? So in TradingView, in general, I'm going to give you the broader answer to this. In the asset that you're selecting, you can do base mathematical operations. So I could look at Dow Jones divided by the gold futures. Okay. That gives me the Dow Gold. But you can do anything in there. You can look at gold divided by silver. Right? There's a lot of different things you can look at. But the main thing is you can do base mathematical operations here. You can divide, minus, plus, times, to the power of, or inverted. Right. All right. If you do the little old lady method, you have to find 3 unrelated reasons, write it all down to buy, but you are also nibbling at 20 coins or more per day. This is oddly specific, and no, not only nibbling at 20 coins or more per day. I have a setup I use that I call planting flowers. I will go into it near the end of the course, where I'll describe how I go about using my planting flower setup, which is a little old lady risk profile setup. But little old lady is a risk profile, not a setup itself. Okay. Little lady just means that you are not taking any leverage. You're risking to the asset going to 0, and you are going to sell half on a double. Okay. All right. Well, I guess selling half a double, I don't know if that's integral to it, but it certainly means that you're going to risk it going to 0. All right. Can you please show us one example of how you trade, checking charts, finding reasons to buy, write it down in your trading plan? I will go through my routine. I would like us to get um, through a few more weeks here before I go into it in too much depth, because I think it's going to be a little overwhelming until we've learned how location works, how momentum works, and we're just learning price structure now. So I will absolutely walk through my routine and how I set up a trade, but I'd like to do that in a few weeks when we have some more tools under our belt. We seem to have 2 shared trading logs going. Well, somebody created an updated version, but I'm still looking at the one that's linked on our chat, right? So if we come to our chat, the one I'm operating off of is in the pinned messages down here at the bottom. I'm operating off of this link here. Okay. The other one's cool. The update is totally cool. I just, for clarity's sake, let's just operate off of this for right now, unless everybody wants to operate off the other one. If we want to operate off the other one, I don't have a vested interest. But this is the one that I've been bringing up because that's the one that's linked in the chat. I absolutely love the updates that I don't remember who did it, but the updates that the people did on that onto the chart. I really like how that looks, but I don't have that link immediately handy. Is there a video or article you recommend for getting the basics of TradingView down? I watched one on YouTube, but still have trouble drawing arrows and circles. Well, I didn't really learn it from video. I just kind of screwed around with it until I figured it out. So I don't really have one for that, but we'll walk through some more of it as we get into some of these assets. We'll show you how to put the indicators on that we're using, and I'll show you some of that stuff. Okay. Oh, I didn't realize that, Brian. So Da Vinci named his methodology Little Old Lady. Gotcha. Okay. All right. And then all the videos you sent me via email don't work. Okay, so PM me if you can't view the videos that that I have linked over there. So they get emailed to you by YouTube when I add your permissions. Now I'm adding the permissions for people to view the videos based on the email address that I have, which is either what you signed in with the site with, or if you've given it to me directly, it's the one that you've given to me directly. So PM me with whatever email address you use to log into YouTube with, and I will give that that account access to the videos. I would like to note there are 3 students so far who, in spite of being given permissions to the videos, can't view them. I think it has to do with region. 2 of them are in Australia, and 1 of them is in Korea. In those cases, I've also linked the videos into a Google Drive, and I'll be happy to give you a link to it. So just PM me if you can't get to the videos for whatever reason. All right, what are these groups that are mentioned in each week's document? I don't know what you mean. So I'm happy to answer this question, but I don't know what you're talking about. And what is your take on OTC trades and its non-effect on momentum and volume? Well, I can only trade what I can see, right? So I'm not saying that OTC trades, especially large OTC trades, aren't a factor. They absolutely are, but they don't typically affect my day-to-day trading. They don't I don't need to know about them in order to trade successfully. However, when I do find out about a large OTC trade event, that I often treat that as a big fundamental event. Like if there's an auction or something like that, right? That's a big fundamental event. And why are you lagging so much between the live stream and the chat? Well, because I have to, in order to record this, it has to feed from my computer over to YouTube, and there's just a delay on that going in. So that's just part of the technology. All right, so I think that's all that. Let me see if there's any more questions. Yeah, I know the fundamental stuff, especially for people that are primarily technical traders, can be very overwhelming, right? People that are interested in the charts, the fundamental stuff can be very overwhelming. Was for me, and there's a lot of information we're throwing at you, so just bear with us. It will come together. Okay, it may take some time. It may happen hopefully during level 1, but we've had a few students where they kind of got it enough that they passed the final, but they say that it took them a month or two for it to really sink in fully after level 1. But I think a majority of people by the end of level 1, you should be good to go. All right, so just bear with us. Ask me any questions you have, right? PM me, PM Brian. We're happy to help you with any questions you have. Our goal here is really about making sure that you guys have the tools at your disposal you need to be good traders. Regarding the groups in question 7, in the text-based document as part of the class, we get answers to question, what are these groups? Well, let me see what we got. Groups. I'm not sure. Brian, maybe you can speak to that a little bit. I don't know what did at one point in the class did you have them breaking into groups? Guys, I wouldn't worry too much about what are these groups. There's not like mystery groups that you're unaware of. I think what this comes from is previous classes where we might have broken people out into groups. Some of our classes we've had were particularly huge, right? And so we had to kind of split it out to manageable groups of people. There we go. As Brian says, this was taught over a week period. Oh man, and he used to teach it in actual classrooms. That's wild. All right. Okay, guys, I should probably wrap this up. We're now 3.5 hours. I apologize for the length of the session, but I'll give you guys like 3 minutes for any other questions you might have. All right, guys, give me a few minutes here to ask any last minute questions you got. All right, let's see where we're at. All right, guys. All right. Oh, get a sip of coffee. I'm just hanging tight in case you have any more questions. Be happy to answer them. So, just so you know what to expect, next week we're getting back into a little more vegetable eating. We're going to talk about risk management, how we can deal with that. And then after that, we're going to dive into the. After that, we're going to dive into the candy store in full force. Okay? So, one more week of vegetable eating. It's pretty good vegetable eating, in my opinion. I really liked the risk management week. But, yeah, Colleen, I fully intend for us to go through the trading log as well. I apologize. So far each week's been so long that we haven't had a chance to do it. But as we move into the technical bits, the candy store, we should have more time to go over trades as well. All right. With that, guys, I'm going to let you go. If you have any questions, as always, PM me, PM Brian. We once I can't say it enough. We really want you guys to succeed and for you get all the information that you need. So for now, I'm going to let you go, and the Broiler Chicken Show is going to start at the bottom of the hour. Hop on. Feel free to ask questions of Brian. He'll give you some detail there as well. And with that said, bye for now.